Bueno, hola, buenas tardes a todos. A nuestra tercera edición. Gracias por estar aquí.
Time we have this meeting, and thank you all for being here this year. Apart from the cars, we have an application that I hope that it was useful in order to facilitate the Q&A session and to make things easier. We have many questions already formulated that we've already received and that we will try to answer the best way possible. It's been a very complicated year. We're going to try to take a look at what has happened, and we will see what the future will bring us. As usual, we're going to be talking about the funds, about what happened. We're going to review what happened in history, because we have many people around us, people asking if that happened last year is the first time that happened to us, if we're going to be doing different things, if we have any undesired news, and we're going to review what happened last year, and we're going to see how it had happened even before, and even worse than what happened in 2018. We're going to review the potential of the portfolio and to explain what we have to rely on the potential of the portfolio, and then we'll do a portfolio overview, and at the end we'll have a Q&A session. So a brief overview of what has happened. We're having these 2 billion euros under management right now. We are having institutional investors, pension funds, hedge funds, and last year we had some net incomes, despite it was a very complicated year for us, of 264 million, as indicated in there. In the month of January, we had almost 400 new registrations. So despite the negative impact of the losses suffered by the funds, the truth is that most of our customers, we can say that they understand what we're doing and what has happened. Hopefully this will be helpful to clarify things even more, and they behave the way that we were expecting them to behave, because they're focusing in the long term. Let's remember the performance of the funds that have been very interesting and very interesting, but we have to concentrate on the bad things, and we're going to concentrate today's presentation that it is going to be rather long but interesting in the international portfolio, which is the one that suffered important losses past year, and this is what we're trying to manage right now. We didn't do that bad in Spain, and to do that we're going to review the past, and we're going to do a past performance overview, because sometimes we say this happened in the past, we're doing things differently, but as you will see, there's nothing new under the sun, not even for us. This was our first year, the first year that we were managing a global international fund, 1998, with a drop of 17.5% in our profitability, or in our yield. We've had four periods of losses. Then it came 2002, after the recession in the US, after the attack to the Twin Towers or the World Trade Center. Then we had the incredible crash of 2008. But I remember a presentation on March 8, when we were having some customers who had lost 62% of their savings. Hopefully this is something that will never happen again, but it was a really complicated moment, but at the same time it was very interesting, because this established the pathway that we took afterwards. And then we had last year when we had losses of 23%. So we have 4 periods of losses, very important losses in some cases, as you can see now in the screen. And what's more interesting about these 4 periods of losses is that in 24 months time, not only had we recovered the losses, but we were achieving a tremendous performance, extraordinary yield, 68, 78%, 64, almost 65, 153%. So the best profitability we've achieved in 20 years came after these episodes of losses. Obviously, we do not know what the future will bring, but this is not a bad starting moment, thinking that what happened last year happened before several times, and right after these things happening, we see episodes of tremendous profitability. In fact, only in another period in these last 20 years have we seen a profitability of 60-70%. It was in the period from 2005 to 2007. The periods of high profitability were preceded by moments of important downfalls. So we all have to remember that despite the problems that we have with this percentage fall of 1738, the average profitability was 12% of our funds versus 2% on the stock market. So we have to be careful, but in order to obtain good profitabilities, we have to be on the market so that we can earn our fees and earn the money that we provide to us customers, and sometimes we suffer losses. But we are going to concentrate in these two episodes that have taught us some lessons. The first one was the fall in 1998, and we see this what happened. Not only did we lose 14.1% in the period that went from January to December, but the stock market went up by 16%. So we did 30% worse off compared to what the stock market was doing. So we must not have a good beginning, but this was a tremendous obstacle, a tremendous hurdle that little by little we were able to overcome. What happened in the next 2 years is that at the end of the year 2000, we were having a profitability of 150% ever since the beginning. Not only were we able to overcome the losses, but we incredibly recover. So we've had some falls, tremendously relevant, behaving much worse than the stock market with this period of 30%, and we were having these losses with the stock market going up while we were falling by 12%, and these things have happened. Also, I wanted to talk about the period of 2011, the falls that we had in 2011. The losses were not that bad, 22.9 due to the euro currency crisis, and with a profitability of 130% after a few years, recovering the losses and achieving very good yields. The specificity of this period of time, of this downfall that came preceded by some errors, is that one of our greatest investments was Chile Cofride, and this was where we were investing 30% of our portfolios. It sounds very similar to what happened last year with the Ritza, that it was a value that had a tremendous relevance with SIR plus Cofide. As we can see in the case of SIR plus Cofide, we made a tremendous mistake in our valuation. The same thing that it is happening right now with the Ritza, for different reasons, but deep down, same problems, making mistake in the valuation. This is the problem that we can have. We never get nervous with the markets, and we do not operate based on emotions. This is not what happens. What happens every once in a while is that we make mistakes, and we were participating in the first line of the valuation, and we saw that there was a company called Sorgenia that we had value in 2 billion in 2009, but in 2011 we have to drop our value to 354 million. So there was a loss of 84% in our valuation. Up to date, that subsidiary costs 0, and that's the reason why we suffer. We made a tremendous evaluation in the weighting of SIR plus Cofide, and that's meant that the objective price that was 4.4 in 2009 for SIR plus Cofide became in 2.4 in 2012. Nowadays, the estimated price is 2 euros. So that's why we say that we are still having in our portfolio because of the current price that it is having, and we see a significant potential for growth. So we realize that we've made important mistakes in the past that haven't meant that we have achieved a good profitability in the long term, but we've not only made this type of mistake with SIR and plus Cofide, but in 16 years of age, in our previous life, we've committed 45 investment errors, and except for SIR plus Cofide, in the other 44 cases, we've either lost 100% or 90 or 87%. We've practically lost the whole investment. So if we divide 45 in 16, 17 years, we're seeing 3 errors per year, full errors per year, and this is what it is. And despite that, we are achieving extraordinary profitability levels for our customers. So what's the lesson learned? That we've had 45 investment errors, but we've made 500 investment, and out of them 450 we're doing okay, and only 10% we're doing wrong, which is a reasonable percentage. Of course, we can always make mistakes, but we have to limit the number of mistakes that we made and the amount of those mistakes. But that is the past. Why now are we seeing the recovery like the ones that we saw in previous year? Why are we expecting this recovery? First of all, because we're having an upside potential of 138%. We will get into greater detail because this is the key. This year we have to drop the valuation because of Aritza, but now the coefficient for upside potential is very, very high. Also, because there is a certain concern in the markets. We'll talk about this later on as to the economic cycle, what is the current situation of the markets. Our portfolio in general terms is very defensive and conservative, even though it might seem otherwise because of the losses that we suffered last year. But for 2 years, we've been very defensive in our approach, not increasing the cyclicity, and we've increased it this year because of automobiles and other things that we'll talk later on. But in this cyclic component that we have in our portfolio, we're talking about companies that have losses of 30-40%. So the cycle is already reflected in their valuation. That's why we're not concerned about a possible drop in the markets and a possible fall of the markets. And finally, something that it is very obvious, but I wanted to highlight it in here, although some people say, I don't know if it's logical to say it in here. We've been 2 years as a shareholders in most of the companies in which we've invested, and obviously when you've been an investor for 2 years, the degree of knowledge of the situation of the companies increases dramatically, and this always happens. No matter how much do we analyze a company before buying it, we are always more knowledgeable about that same company 2 years after the purchase. That's only logical. You cannot do all the work before purchasing. The knowledge acquisition work is a permanent work, and the more that we devote to know the companies in which we've invested, the more we know about it, and the degree of trust in our valuations is much higher than the one that we had last year or 2 years ago, and probably next year our level of confidence will be even higher than the one that we're having right now. So as of December 31st, we were seeing a potential valuation with a portfolio with a return on the capital that was very high. It is true that we're having 25-30% invested in companies that suffer because of the economic cycles in sectors like the marine sectors that have an ROC that it is low, but we're having a price that it is a bargain with a yield of 26%, because many of these companies in our portfolio are having net cash, although a few of them having some liabilities and some debt, but most of them they have a net cash, and that gives us a tremendous confidence as to the valuation, although the price has fallen from 200 to 172, and most of this fall is due to the valuation of Aritza. And we always insist that we're working on the objective value, and we try not to make mistake in this target value, and we try not to make mistake in that sense, and we try to make sure that our upper line is our objective, and its target value always trying to go up. In the Spanish case, it's always been the case, and we always generate value. We haven't done it because of this drop in the valuation of this company. In this 132, we always try to make it 180 or 200. This is what's always happening. In order to see if we can trust the target value, we've also analyzed this from a historical perspective, and we see what happened in our last important portfolio in the year 2011. The moment that we were having these 5 values within our portfolio with valuations that we were having, we're talking about Exor, Bolsters, Cobas, Thales, BMW, and Schindler. This is very interesting if you can follow this presentation. And in these companies, we were having target values in 2011 way above their stock market price. We thought that it was worth 41 compared to 18, with Bolsters, Cobas 34 versus 16, Thales 56 versus 28, BMW 104 versus 40, and Schindler 143 versus 110. That was the target value that we thought, but at that point, the European crisis was starting, and we saw a great potential in all of the values. So I challenge you to tell me where the values are now, 6.5 years later. But we're going to go right to the point, and that's the current value today, the price of the companies today. Exor is 35 on top of the target price that we were saying that it was going to have 5 years ago. Wolters Kluwer is at 54, 50, 60% on top of the target price that we had for 2011. Thales is at it's twofolded the target price that we thought that it was going to have. The only one that it is not above our target value is BMW, but the characteristics of BMW is a cyclic company, and it is very highly affected by the economic cycles. These are the preference shares that were costing 90 euros in the peak of the cycle, which was 2015. It reached the objective price, but it has fallen now because automobile cycle is now negative. And still, it's higher than the target values. So target values are working okay, and they're useful when you do a good calculation. So we believe right now that we're doing a job. The problem is that target values are not static. Companies cost more and more every year. Exor, we thought that it was worth 41 euros in 2011, and now we think that it is worth 85 euros per share. So this is what we're intending to achieve. The potential of Exor is so high that we're having a very little investment, but it is important for the selected portfolio. The same applied to the others. Wolters, Kluwer, Thales, BMW, they have all increased their value this year, and this is something that we're seeing on the target value. So I think that we need to believe in our target value. Here we indicate the target value of our Iberian portfolio as well as its potential, with a good piece of news that ever since we started working here a year and 8 months or 9 months ago, the target value has always increased, with some minor problems like the IRIA case last year, but as happened with the rest of the portfolio, we've been able to create value. The way that we create value, increasing the target value, because we find good, attractive things at a very good price. Also, we need to pay the profitability over the capital, an attractive price, and the truth is that when we started working with Iberian portfolio 2 years ago, we couldn't see many opportunities. Some years ago, we were having 100 euros, and we thought that we could have 37% more. So this is a huge potential, and hopefully we will take it to 175 in the next 2 years, and if we continue on in this line. Let's do a portfolio overview very briefly, the Iberian portfolio, and we're going to be focusing then afterwards in the international. Since most of the values haven't changed, we've increased our position in Sacyr, in Bankia, in Mota and Gil, the Portuguese company, in Atalaya Mining, which is a piece of news. This is a mining company, the old Minas de Rio Tinto, a Spanish company. We've purchased Prosegur. Semapa has fallen from 24 to 14, and we've purchased again in Coabit, the real estate company, for small prices that we think that it is in a negative situation right now. And this is the portfolio that we have. We like it. It's very interesting. The rest of the portfolio is also interesting. We've been able to take advantage of the downfalls of some of the values without the worsening the situation of our portfolio and increasing its potential. And this is all about the Iberian portfolio. We're not want to take any longer because that doesn't generate any doubt. The international one is very similar to the one that we had last year. We hardly got any pieces of news, but we're going to concentrate in it a little bit more. I'm going to specifically talk about Aritza and TK, which are the two companies that have produced the greater losses. And then we're going to give the floor to Juan Carmen and Gorga and Andres, who are going to be talking about the rest of the values. Let's concentrate on Aritza, which is our first, it's not our first mistakes, and sadly it's not going to be our last error, but taking a look at what we did in the past and concentrating in the future, we see that we did some mismanagement that we were not able to see because of the trust that we had on the chairman. We were trusting the chairman very much in a transition period, and in transition periods we should have been more careful because we saw an increase on the cost both in Europe and in the United States, and the new team was not capable of managing this correctly. Something that was not a problem when we started investing the liabilities with the EBITDA in a very stable company, in principle meant no problem. But when EBITDA went from 550 to 600 to 300, as it happened, liabilities became a problem and the debt became a problem. Of course, there were other alternatives compared to the ones that were proposed by the company. We're talking about a stable business in a growing market, and we thought that things should have been done in a different way. But for a series of reasons, shareholders decided, voting by 52%, to do a capital expansion that was very high compared to other alternatives that could have been studied and were not. And this is what has happened. Our greater mistake, apart from being overconfidence of the management team, because we didn't think that they did a good job, and this is something that has happened to us in the past, will happen again, because it's difficult to evaluate these management teams, especially in companies that have no owner. There's no family behind, and we always say that families made us feel more confident and more, we believe that they are more trustworthy, and we invest practically in family companies all of our money, but sometimes we do not do so, and you think that you have a management team of executives that can do things correctly, and we invest. But our biggest mistake was this overconfidence in a transition period with a new management team. Although this business is very interesting, very attractive, and highly desirable, well, we failed here, and we gave them an excessive weighting. And we continue on purchasing shares, doubling up our mistakes, thinking that this was a temporary problem. Maybe this is a temporary problem, but maybe we should have been a bit more prudent. What about the future at this very moment and with regards to the company? Because we have to take into consideration that we've accepted this capital expansion. Well, the good thing of this 1 billion capital expansion is that you go from 1 billion to $2 billion capitalization, and the debt therefore has been highly reduced, so we're not seeing a dangerous fall in the results, and in regular circumstances we will see part of our investment being recovered. We believe that we are going to recover our investment, not fully, we'll lose a little bit, but at least part of the investment will be recovered. We do not know if it's going to be 50, 30 or 80%, I will say. Our intention is to continue investing in the company because we believe that the business is attractive. In that sense, we believe that we've made no mistake, that this is a good business with some assets in some of the geographies that are very, very good, extraordinary, and other assets not so good, but hopefully these assets will be well valuated by the market. And we see right now that the discount situation is very, very high versus some of the peers, although there are not very similar companies. In this case, the comparators, the peers, are Flour Foods and Bimbo, and our price of discount is 30% compared to this company. And now with the current price, a bit that today is very depressed, but if they recover, things will be much better. As to the sales, we're also doing this discount of 30%, and with regards to the assets, a 50% discount. This is up to date with no improvement part, but if the company improve, as we are all expecting, this margin that we're having right now, this 8% that used to be 14-15%, well, can be similar to the one of the competitors. Company has a plan of getting 12%, etc. We do not know whether margins are okay, but they look like they have to have higher margins than the ones that we're seeing today. We think that it's feasible for this company to achieve this margin, and if this management team is not doing it, I'm sure that there will come a new management team that will do it, and in that sense the valuation will increase in the market. We believe that the valuation of the market makes no sense. Some people may wonder, are we making the same mistake now? No, the mistake was investing in a REIT where the company was worth 3 billion euros the way that we did it. 2 billion plus the debt of 1 billion. Now right now we're having a lower billion, and it is costing 1 billion on the stock market. The situation, the investment situation now has nothing to do with the investment situation that we had 2 years ago. We definitely made an error at that time. Now that we see it is very clear, but now we think that the differential is much higher than the one that we had 2 years ago. That's normally the case when the company collapses in the price. Well, now it gains a new opportunity, and I think we can take advantage of that new opportunity. And now we're going to be talking about TGP. This company affects us in our valuation, and the company is improving. It's definitely improving. It's not doing bad. On the contrary, it's doing very good. When we started investing, we invested very importantly in 3 companies. One didn't work really good, or we can say bad, Aritza. The other one that is doing okay, which is ICL, Israel Chemicals, that increased 60%. Last year we sold it and we obtained important profits. And then the other one is TGP, and the company is doing really, really good, as we're saying. However, the market is not reflecting how well the company is doing. But let's take a look at the historical situation to see the opportunities that we see in the financial market and opportunities that we never see in the real market. This company in 1998 was quoting or having a value of 40 per share with a capitalization of $6 billion. And at that moment, we launched an investment plan that will help them to get 200 million, and with new with long-term contracts, some of them 25 years old, that will help them to obtain 200 million profits by 2020. That was expected, a net profit of 2020. Since it was financed when the oil price went down, they couldn't get the finances, so they did something that was very sensitive, that we explained, that they cut down the dividend so in order to finance the investment plan. Obviously, this is what they did, the dividend cut. And what happened, that the share value fell from 45 to 10 euros per share because of the dividend cut, as well as for the drops in the oil markets. So they continue on with their capitalization, although the financing was coming from a different way. And when we started working at Cobas, we saw this good opportunity. We were investing on a company with this valuation, and they do have a plan that will generate a net profit of 200 million for 2020. What's happening today? After the falls of last year, we're talking about a company that it is about to generate $200 million in net profit next year, that it is worth 1 billion in the stock market. So our investment plan is being fulfilled. We're about about to get these 200 million profits, and the company, instead of costing 3.6 billion, is costing 1 billion. You know that I've been working on the market for many, many years with a very broad experience. I don't remember many opportunities like this one, especially in a market like the American market that is somewhat complicated, because it's difficult for us to see this type of bargains and this type of good things. The share is giving you fivefold in the benefit, so and this benefit is supported by long-term contracts. It will not depend on a commercial war or trade war with China or this or that. No, they have to pay BP or whatever. They all have to pay. They're having long-term contracts, and people is paying in this business. These are very long-term relationships, and we are going to enjoy the profits and the dividends over the coming years. Sincerely, we're interested for the stock price not to go up. Why don't we want the stock price to go up? Because the company has decided to repurchase shares and to cancel that for $100 million. Why? Because this year, which is a transition year, is being better than expected, and they're going to make 80 million euros or dollars more, because they have achieved very important things on the market. In fact, some of the last tankers that were going to start operating on 2020 are going to start operating in September, October 2019. So things are better than they expected, and the company is going to take advantage of that situation in order to repurchase shares. So if they repurchase these 100 million this year, they are going to recover and will all benefit more from this profit cake. So little by little, the share price will start increasing. The fall that we saw in the last quarter was totally absurd. It was due to the fact that some people were expecting for a higher increase on the dividend, but we think that the management has done the right job. They've increased the dividend by 35%, but they're complementing this with the repurchase of shares.
And I have no way to explain this, but I think this is going to provide very good results. So you need to come up with the valuation that you want. We're talking about 200 million in profit, 2.7, and whatever figure you want. Actually, the company is working out quite well. We also see cash flows in TGP on this slide, and we see that they've been flat throughout the investment process. And there's been a leap because of the new dampers that were coming in this year, next year, and next year. Well, actually, this year they're starting to work with those boats, with those ships, and just imagine how much gross cash flow that's going to represent. Part of it will be devoted to repaying debt. Some people say that these are companies that are highly indebted. Obvious. Of course, it's such a good asset that at the end of the day, everybody is getting a mortgage on it, so to speak. Practically, it doesn't make sense to invest on a home without a mortgage. I have all my savings in my funds, and I could pay my house without a mortgage, but I do have a mortgage because it makes all the sense in the world. So assets at the end of the day are funded through debt, and banks are keen to fund this type of assets. And banks are funding with 200 basis points of spread, and so this is practically no risk for a bank. What TGP does actually is to do hedging so that the variable rate doesn't affect it in the long term, and this causes the real cost of financing to be 5%, which is not bad, with a yield of 9% or 10%. We are getting higher yields because we're buying at a discount compared to what they had for their dumpers. So that was it for TGP, and now Juan and Carmen are going to analyze the two main companies that we have in the UK. In the UK, the idea is crystal clear. Assets have plummeted by 80%, taking into account debts and stocks due to Brexit, and that's where the opportunity lies when people actually are not keen on those type of stocks. Hello, good evening. When we invest in Babcock, we are investing in replicable and non-cyclical businesses where trust and reputation are key. This is the main UK company, the only UK company with the necessary experience to carry out the maintenance of the high percentage of fleets in the UK. And this maintenance has to do with one of the most important budget lines of the defense budget in the UK. And they're an unchallenged leader in Western Europe in helicopter emergency services. Firefighters, doctors, sea rescue, more than 530 aircrafts, and they're very capable to compete with their competitors and assure stable growth for themselves in the future. The strong advantages of Babcock have also been reflected in the profit per share in the last 15 years with an increasing performance, but in the last 5 years the price per share hasn't gone along the same track, and this has to do with the exaggerated irrational fears having to do with the Brexit today. The room for safe maneuver is huge for a company of this kind. After interviewing more than 10 independent experts, 11 analysts coming from very prestigious firms, and 8 managers, we haven't found a reason for this company to be so affordable, 7 times profit and offering a 12% yield. So it's a matter of time that Babcock contributes with good profitability to our international portfolio. Now, Carmen Perez is going to present another key investment that we have in the UK. Thank you very much, Juan, and good evening, everybody. For those who are not acquainted with the company, Dixons Carphone is the result of the merger of Dixons, who is the #1 electronics retailer in the UK, the Netherlands, and Greece. And on the other hand, Carphone, who is the #1 in cell phone distribution in the UK. It's 60% cell phones and 30% in the UK, and 30% happens in the Nordics, and the rest is Greece. As you can see here, it's a company that has very high yields over capital, and it's protected by entry barriers. And it has to do with its capillarity, which is extremely important in the case of big size products, such as, for instance, home appliances and large TVs. And at a point in time where many retail companies are feeling challenged by online retailers, Dixons has shown that it's capable to objectively compete with Amazon, and actually they've earned more of a market share effectively in the last 5 years. And in spite of all these strengths, Dixon is one of the companies that plummeted the most after Brexit. This has allowed us to buy Brexit less than 7 times profit when Best Buy trades at 10. This is displayed on this graph, where you can see the disparity of the evolution of both companies. As you see, Best Buy, that does precisely the same as Dixons in the US, in the UK, has tripled its situation in the last few years, whereas Dixon has fallen by 70%. Actually, in the last few years, the stock value of Dixons Carphone has dropped sharply. The current value for Dixons Carphone is 20% the value that Dixons only had before the merger, and we consider that in spite of the different risks of a possible recession in the UK and the problems that they had in the cell phone business, the market has overreacted, and this means a very good opportunity to invest in Dixons. And I will give the floor to Paco, because he's going to continue with the presentation. Thank you, Juan and Carmen. We are going to talk about the cyclical companies that Juan Soto Huerta and Sai are going to give us details about. But before talking about that, we are going to mention that 25% of our portfolio focuses on cyclical stocks, internal cycles or external cycles, as Andres will explain. also what we see in automotive companies. But before we talk about this, I would like to talk about the moment in time of the cycle, because apparently we are in a very bullish market moment. People say that there's drops around the corner and that we need to be cautious. We don't tend to talk about markets all that much, but I just wanted to propose a different perspective on compared to what you read on the press. Morgan Stanley, that has been on the upside for the last 5 years and 8% after the falls experience last year. As we know, this index is mediated by the U.S. and in the U.S. we know that there's a lot of technological competition, and we know that that has made S&P to behave very well, to perform very well in the last few years. But if we see Euro Stoxx 600, the situation is not so clear. It doesn't seem like we are in a very good moment in terms of markets. We are not booming economically. Since 2015, since when I think the stocks reached a historical maximum, when BMW was at 90 euros and Daimler was practically 100 euros, and now they're at 50. So these companies are a good benchmark as to where we stand in terms of the cycle. But since 2015, there's been 3 years, actually 4 years, because spring is already around the corner. For 4 years, the European markets haven't really performed well. Actually, they have showed declines by 10%, drops by 10% in the last 4 years. And this is not a good basis for a huge earthquake or a tsunami. This is not a good foundation for a bullish market either, but it's not actually a breeding ground for a sharp drop to hit rock bottom. It's quite a boring market, actually. It wasn't affordable in the past, but now it's more affordable than it was in a couple of years ago, so there's more opportunities to have good results. There's many companies that we've known for a long time, and they have dropped by 40%, so there's a very good prospects to invest in new things as things increase or improve. And what we've done is actually to make the best of the falls of automotive companies, BMW and Hyundai, BMW by 28% or Hyundai by 28% too. And we've had more exposure in Renault and Porsche. Porsche has dropped by 43%. And we are in a low cycle, and the possibility of having a bearish market that is ongoing, well, we don't know about how much that will crystallize, but I don't think what we read on the press, what people who are supposedly qualified publish on the press, I don't think that's going to materialize. So we're going to talk about automotive first, and then we're going to talk about tanks. Good evening. On the next slide, I'm going to try to explain our investment case on the automotive business, where we have approximately about 10% of our international portfolio. As Paco said, this sector is a sector where we see a lot of pessimism in terms of the price attributed to companies. These are our main investments. We also have BMW. It's only 3%, but these are the companies where we have more of our assets. Porsche, which is Volkswagen, and Renault and Hyundai. Capitalization at 2018's closing on the 31st of December is what we see in this line, but it's currently high. Renault has increased by 12%, Volkswagen has increased by 8%, and Hyundai by 12%. So they've performed well. year to date. And what I want to say here is that these companies are being punished, and they're so punished that there is hidden assets in those companies. The main two reasons why they're being punished, one of them has already been brought up by Paco. In the automotive industry, we are discounting part of the drop in the economic cycle with discounts of 30-40% in companies where we are invested. And the second main reason is that these companies and the sector in general are facing disruptive waves and future risks, such as self-driving vehicles and emission limits and so on. So this is capitalization, the capitalization that we have. But here, in the next slide, I would like to show the stakes, the main stakes. In the case of Renault, that's our most important position, 13 billion euros, and they are participating by 43% in Nissan. They have a stake of 43% in Nissan. And this is remarkable because this 45% that they hold in Nissan is at market price. And Nissan is also being punished. If we are to make our own valuation for Nissan, then the value will be lower. A very important part of this of the stake is Daimler, which is also the parent company of Mercedes. And this has to do with two main reasons. First, the trucks division, Volkswagen is the owner of MAN and Scania, two groundbreaking brands in the truck sector, and we attribute a value of 20 million euros for those. And the second part, amounting to 40 billion euros, will be Porsche, a brand that we are all acquainted with, a luxury brand, a premium brand that we have a right valuation for. And Hyundai, the figures are a bit lower, but we consider that net cash figure is almost the same as the market cap that they have there. So it pays off. So this is the net cash for Renault in their balance, which is 3 billion euros. Volkswagen has 20 billion euros, and Hyundai is 12 billion euros. It's important to highlight that these companies didn't have a net cash position in 2008 before the financial crisis. They were indebted. Now their finances are way leaner than before the financial crisis, and this has led the market to have an irrational valuation on these companies, which has to do with the hidden assets that we mentioned earlier, because the implicit value of these companies, taking into account the stock price, is close to zero or even negative. So what this means to say is that the market is saying that we can invest in these companies and obtain the rest of businesses that these companies also run for free. In the case of Renault, they produce 4 million cars a year with a profit, with a free cash flow of 1.5 billion, and that's not included in the stock price. We're accessing that 100-year-old business for free, and at the same time we have the financial business, because many of these companies have some sort of bank within the company that provides access to purchasing these cars. So and Renault has a service that's worth 5 billion euros in their books, and we're accessing that for free too. In the case of Renault, we also have an access to Seat and Skoda and Lamborghini and Bugatti, premium brands. And if we were to actually value with the same criteria as these companies, with the same criteria that Ferrari and Aston Martin are valued by the market, then we would be way above the market cap. And here we are seeing, for instance, that the financial company within Volkswagen is something that we are having access to for free too. And the case of Hyundai is very similar to that of Renault. We are having access to a company that produces 5 million cars per year with a stake in Kia, and we're having access to it for free. And on this slide, I'm going to try to underline the great differences there are between price and value. And it's important to mention that the value that we get to and that we are displaying here is an estimated value. We are not saying that that they're actually worth this much, with decimals exactly. But this is the value that we reach based on very conservative estimates. First, because of the amount of cars that we think the companies will be selling in the future. In some geographical areas, these companies are selling, and they are at the peak of the cycle, for instance, in the U.S. So in the case of the U.S., what we do is to have a breakdown geography by geography. And we don't think that in the U.S. they will continue to sell 17 million cars. We try to standardize, do a median regression, and consider what has been sold on average in the last 15 years, and we get to 14 and 15 million cars. But that's in terms of volume, but also in terms of costs. We're also assuming an increase in costs because they will have to face the drivers, self-driving cars, and so on. And we see that we consider that the margins are going to be lower than the ones considered by the companies in strategic plans for 2020-21. And we're being conservative on that standpoint too. And the multiples that we apply are a bit different. We are valuating at 10 times or 11 times earnings when we consider that these are not replicable. At the end of the day, there is an oligopoly. There's always been an oligopoly by several manufacturers, even though some are trying to get some room for themselves in the market, but it's not easy. So this gives our revaluation potential above 100% for all these companies. And on top of that, we need to add that the sector is not just affordable as such, but we've also tried to select the companies in the sector that also have a very specific investment case that's interesting for us. For instance, in the case of Renault, silent merger is happening between Renault and Nissan, and operationally it's almost concluded. There's no turning back. And actually, just by way of example, they're already sharing their R&D department, which is located in Japan. So they're both developing the future electric engines together. And at the end of the day, that's the heart of an automotive business. And it's very difficult to get cold feet on that. And actually, this year, they wanted to have a 50% integration of the platforms that both companies have. And by 2021, the integration will be 80%. So in spite of all the noise that we read in the press, in spite of the fact that we've read that the CEO has been arrested, the companies have de facto being integrated. In the case of Volkswagen, there is an internal restructuring process, and there's a new CEO, Herbert Diess, and he's turning the company topsy-turvy, and they're focusing on improving costs and getting efficiencies, improving margins, and they have the objective of changing the brand valuation. They want to go to a 6% margin, and it's felt that the company is no longer in the hands of trade unions and the Saxon government, but rather that this is being in a way led by Porsche too, and that there is a good alignment between minority shareholders and the company. In the case of Hyundai, we see that there is a clear improvement in corporate governance. Korean companies are very complex in this sense, but they're doing very good restructuring processes of their subsidiaries so that everything can be clearer. And there is an offshore investor who's very active in the company, and all news point to the fact that everything's quite positive. So by way of conclusion, we think that it's a reasonably good moment to invest in the automotive business. We consider that these companies are worth more. We don't know exactly how much more, but we consider that the certainty margin is quite high, and we consider that the decrease potential is very low, and it's also limited. Why? Because there are assets behind this. There's net cash for these companies, and also they have already decreased by 30-40%. So even if the cycle is reverted, these companies should suffer more, or at least not so much, should suffer less, or at least not so much. Thank you very much, and I'll give the floor to my colleague Andres. Before we start talking about chips and Samsung, I wanted to make a brief remark, because sometimes cyclical companies have a bad name for themselves. They say that people say that if they're cyclical, it's because they're bad quality. I think quality has nothing to do with this. But when we're trying to look for companies with good assets, with healthy balances, good businesses, and good managers at a good price, obviously that is no easy task, and there always needs to be some sort of compromise. So cyclical companies allow us to not give up on any of those concepts and have access to purchasing something when the market is being too short-sighted and too short-term oriented. And on the cyclical companies, we can apply our own advantage, which is the time horizon. In the case of oil tankers, we are talking about a very specific and unique case. I've never seen this, I haven't seen this many times before in my career. And this graph depicts the movement of daily shipment rates or freight rate performance. And we see that in the past we've had the historical low. And it was so low that tankers couldn't pay for the daily OPEX or debts or obtain the results for any shipbuilders to ask for new orders. So that's not sustainable, but it's very important to know why we're there, and it's important to know whether things will improve soon or worsen. So after a couple of years, we come to understand why things are the way they are. And when you look behind you, it's easy to see things, but one of the reasons that justify things is the delay in the delivery of boats that were requested in the previous cycle. But that's done and over with because there's no financing anymore. And on the other hand, there is the return of the Ilanese boats. They were subject to Iranian boats who were under sanctions, and also there were boats that were supporting on the future business. So there's a series of issues that explain why the cycle was so depressed. But one of the most important points that we need to take into account is the age of the fleet, and this is something that cannot be changed or stopped when when tankers get to 20 years of age, they need to be discarded, and most of the fleet is already now approaching the 20 years of age. And there's also going to be a drastic regulatory change that is applicable since 2020, going from single hull to double hull too. It's even more drastic than that. So we're talking about a highly depressed situation where the problems of the past are being sorted out, and we also have favorable factors that are going to start working in our favor since 2020. So all this suggests that this can be a very interesting investment case. Our problem sometimes is that we are too early to arrive to the party, but even though we were early, we've lost 0.2% of the fund. These are the losses caused by the 10% that we have invested. Just for you to get a flavor of the extraordinary opportunity that this represents, we need to say that, for instance, a very good example is International Seaways. If we were to liquidate this company tomorrow without actually waiting to see what happens with the market, the potential would be 90%. That means that tankers could be sold in the second-hand market. We would settle joint ventures, and we would repay our net debt. If we wait for the cycle to conclude, the potential is much higher. This is an example that illustrates why cyclical doesn't necessarily mean bad quality investment. It all has to do with the certainty margin and with the specific points or strengths of the company. And the next point would be Samsung Electronics, which is part of the position of the stakes that we hold in Asia. As you know, our stake is quite relevant in Asia. It's a market where we have found a very good combination of factors: family-owned companies, net cash, and very solid business. Samsung Electronics is a very interesting case, once again, that illustrates this market. And it's very interesting to compare this brand with Apple. There's many Apple supporters. Everybody knows this. Actually, you can be part of a cult, the cult Apple. even, but this in Samsung, this data of Samsung go to suggest that something's not really working well from the standpoint of market efficiency, because Samsung is the one that manufactures the parts in Apple smartphones. 40% of the cost of manufacturing an Apple phone comes from Samsung. They also manufacture many things necessary for Amazon, which is a popular company for many investors. Because there's a gold digger fever now in Amazon, right? People want to do data mining, and this is a business that Amazon has been making profit from since 2015. So it's a very affordable company with net cash, and they are actually providing the ammunition for the competitors to fight their own war, Amazon and Apple. So once again, we're very happy to have access to a company such as Samsung that is cyclical because they're in the technological business, but that's what gives us the opportunity to be part of this amazing situation. And we need to say that cycles a little faster in technology, so it's a fertile land that you can be on top of and try to find opportunities that are not always that easy to see. Thank you, Juan and Andres. We are about to conclude. These are the conclusions. There's been sharp drops, both now as well as in other occasions, with and without mistakes. We've already mentioned that, and we've highlighted it. But our experience is that we have recovered, and we've had yields above those of the market. There is no reason for us to think that the situation is going to be different this time. We have a portfolio that says 7 times profit. Last year we were at 8. We could finish at 6, but that's only temporary. Companies that are 7 times profit don't last very long in the market because things happen. And the portfolio that we have right now can be compared to the portfolio that we had in 2012, and it's clearly better than the one that we had in 2007, 2009, and 2002, and in 1997, 98. So the portfolio is now of a higher quality and with the same possibilities of recovered as in many other situations that we have been able to recover. So before we open the Q&A, I would just like to share a reminder about the Open Value Foundation. As we said last year, 15% of our income, which is 25% of the management company's profit, is going to be invested in social impact. And the thing is that the fund that we were going to release is not available yet because it's still pending approval from Luxembourg, but the team is ready to start working as soon as possible. But we have started doing some other things, and we have another very interesting project, which is Value School to disseminate financial culture, and it's a project that has reached 50,000 people. We have 50,000 people in our community, so it's a huge success. It's an open project for everybody, for managers, for thinkers, for anyone who would like to contribute to this project, and we really hope that this project will have a long life. Fortunately or unfortunately for us, we devote too little time to this project. Fortunately, in the beginning, we did support them greatly, but they have a life of their own now, and I really encourage everybody to follow everything that Value School does, because I think it's a great way to learn. Actually, just the other day, we received a newsletter for this month, and we've had 5 or 6 conferences, and all of them were really interesting, and it's really worthwhile following them. And finally, we are going to talk about olive trees, because we talked about oil a little bit in the beginning, and of course this oil is not going to offset our losses, but we have a project here that we are collaborating with through the foundation Apadrina un Olivo, and it's a noble tree, and sometimes for an olive tree, the long term is 20 years. And I always said that in 10 years, none of our customers have lost money, but in 10 or 8 years, they have. So the limit is about that same rate. So we're very similar to an olive tree. So this is the mindset that we need to have when we work. And now we're going to open up the Q&A session. Santi and Gemma are going to be joining us. We have an hour and a half for questions. We are going to be here until 8. We have set ourselves some new rules. We thought that we're not going to talk much about values not in our portfolio, because otherwise this became some sort of talk show, and actually if there's some stocks that are not in our portfolio, is because we don't like them. There are exceptions to this rule, of course, but the same of our rules will be mentioned by you, right? Yes, thank you.
Buenas tardes a todos.
Good evening to everyone, to those of you here, to those of you who are following this through the streaming that we have available today. We have an iPad, and all the questions that have been formulated through the app are going to be presented here by Santiago and myself. Also, we have been gathering the cards that you were using in order to formulate your questions, and we're going to ask them. We're going to give priority to the ones that were most voted, and we will try to finish by 8. But before we start, we wanted to do a couple of things. First of all, we're making a contest in order for people to get to meet Warren Buffett, and the only thing that you have to do is to take your picture out there with Warren, and then you can upload the picture on the social networks. But the basis for the contest is right outside. Also, we want to hear your honest opinion. We are having a satisfaction survey, and you can do it through the application or through these machines that we have outside, so you can tell us how satisfied you are with the event. Okay, we're going to start. Many questions have been formulated about Aritza. Many of them have already been answered, but since the questions were formulated before these, we will formulate them again, and we will ask them again. We say that some of these losses were more than 10%. We're not supposed to be having more than 10%, and I'm assuming that we bought more than that. Is that the right management? Well, the valuation was our greatest mistake. That was the greatest mistake that we made. In the case of a SmartFit, the management was very appropriate because we started buying for 7 and we ended up buying at 1. And then we sold at 12. So every case is totally different. When you are right after a certain amount of time, it's right appropriate to buy at a small price. But in the case of Aritza, it was not right because of what I said before. But every case is a different case. But I've already explained this. This was one of the most difficult decisions that we have to make when something goes against our own opinion. Whether we're right or not, that will be the case, but it's not easy to answer that question. Let me ask another question about Aritza. They said that in Aritza, you made a mistake trusting the chairman and the management team. Weren't you wrong also in the maintenance of the covenants? How come you bought such a highly indebted company, up to 8% of their portfolio? This is something that we've already mentioned. Debt is not a problem until it becomes a problem. And when we started investment, it was only a relative problem. Debt was not so problematic. 80%, well, not 80%, but a very important part of the debt, 800 million that they had in debt, was a debt that didn't meet any covenant, any financial risk, because it was a debt, subordinated debt. So the level of debt was aesthetically high, but the real debt subject to the banks and subject to covenants was much lower than that. And this is one of the discrepancies that we've had with the management team of the company, because they have considered the subordinated debt as if it were a senior banking debt, and they made the decisions based on that categorizations. But it is true that debt was a problem, but we realized the moment that it was impacting our profitability. Within the investment community, there were hearing a lot of noise. noise that it is affecting some managers with an extraordinary track record that says that maybe this value style that we've used for some years is not working anymore. There are companies that are starting to buy and invest in Indian companies. So this value traditional style is dead, or it's still alive? That's the question. Value doesn't exist. What is value? Value is buying good assets for a good price. This is what we're doing. We all try to do the same thing, buying good assets for a good price, assets that we're capable of understanding. Of all the companies that we've spoken about today, we understand how they're working, and we think that in 10, 15 years of age, they're going to continue on selling the same products for a good price. And this is what value is doing, buying sensitive things at a good price with a discount of their assets. And I think this is what we're doing. This is what we've presented today. Anyone tomorrow will be buying the companies for a much higher price. The other things are labeling things and using other adjectives. Of course, buying things at 6 times the profits is not value, nor volume, but it is totally right and it makes totally sense. And this is exactly what we're doing. And if you buy it 7-fold in the profit and it drops to 5 times or 6 times, it could happen. Let me remind you that in 2009, the average was 4. Then we were having 140% profitability, but we were suffering at that time. Value is there, and it will continue on being there because there will always be human nature making mistakes and allowing companies like the ones that we're having in our portfolio being there for a very bad price, a ridiculous price. Share has been on the market or in the portfolio for 10 years. During this time, their stock market value hasn't changed. You haven't done anything with Laudo Mondadori. Chill, an example of the transitions that we have from value to deep value? Not really. Here they've made some mistakes. The main one we've already seen. They were sadly being offered to purchase their participation for 2 billion, but they didn't accept the sale, and this has penalized something that was valued with 1.5 billion going to 0 has had a tremendous impact on the company. And right now there are many businesses, especially one business that it is a growing business, undervalue in a company that, correct me if I'm wrong, but I think their valuation is 100 billion, and a very, very good business that could cost, I don't know, could be worth another 1 billion. I don't know if it's deep value, you can name it whatever you want, but today I was seeing how Cofide, who is the owner of Tier, is repurchasing shares of the company and stakes of the company and canceling, given the undervaluation that the parent company has, both Cofide as well as Tier. So these are assets in which you are buying $1 for an amount of 50 cents. Good things will happen. It always happens. In some cases, we will try, or it will happen, that the values that are there are not growing very much, but we try to buy companies who grow over time. And this is one of the assets that it is growing, and the market is starting to value it. We do have a question about TGP. What's the worst scenario that you are considering for TGP valuation, including the IDRs? We've reduced our stakes in TPEC in favor of TGP. Are we afraid of the refinancing? The main fear in TGP is that deep down it is a bond. Since we're having these fixed contracts, we're not taking any risks of counterparty risk, but at the end they're paying a fixed amount. So we're going to make $200 million over the next 15 years. If there is some inflation, these $200 million will lose part of their purchasing capacity, and that's the problem. We're buying a bond with a TIR of 15%, which is not bad, but it's still a bond, and that's the main risk that we're taking with TGP. It's a minor risk because the inflationary situation is not relevant at this moment, but over time it might not even be a problem, but that's the main problem that we're having. And in their parent companies, TJ Corp, we're having a less investment, but it is true that 60–80% of the assets of the parent company is on the subsidiaries. So from our perspective, the subsidiaries' price have fallen, and so have the parent company, but there's no justification for this. You can say that there are some tankers that instead of costing 300 are costing 200, but we see no risk whatsoever when we're having a company with a net debt of 300 million plus 100 million of convertible bonds, 800 million net debt, and with assets that, well, we can discuss their valuation, but they're in between 1.5 billion, 1.2 billion. So that's, you can get an indebtedness of up to 20% of your assets. That would be reasonable. And that's the case of the parent company if you do a good evaluation of their assets. So we're reasonably calm. And talking about TK, can you consider the risk of the 3 FPSO? Well, I have already mentioned it. I have just said it. If instead of 300, they're costing 200 in the worst possible scenario, we've calculated in assets that we've valuated in between 1.3 1.5 billion. It could be a 5% less of the valuation. So instead of 12 euros per share, 11 euros. Right now, they're at 3.5. So we can think that this is the worst scenario, and the share will still costing twice as much as what we're buying for it. Have you asked TK to eliminate the dividend? What is your opinion about they continuing to paying dividends or paying out dividends? Do you think that they will be able to refinance their debt? I don't think we'd say that Elisa was going to do a capital extension. We said that in the worst possible scenario, in that happening, we were going to participate, but we thought that it was going to be smaller than what it really was. But you never know what can happen in the future. In this case, with a number of assets of the company, it wouldn't be logical for TK to expand their capital, but it wouldn't be the end of the world if it happened. But it would be very strange, in our opinion. Next question. As partial owners of several companies through the Cobas vehicles, I would like to know how our business working, which are the ones that are doing better, which ones are doing worse. Well, I think we've already reviewed 60% of our portfolio. In all of them, they're having a minor problem here and there, but in general terms, our business are okay. Even in Aritza, taking into consideration the drops of the profits, the sales are okay, they're stable, and now we are recovering our profits. In terms to TGP, they're having very long-term contracts, and the company is doing better than expected. In Dixon's, in Bangkok, they've had certain stagnations in Bangkok, in Bangkok, in the this and in Dixon, Babcock, sorry, but now they're having a recovery in Dixon, so they're doing a reasonable good job. So taking into consideration that we're getting sevenfold in the profit for the majority of them, we're not seeing a growth of the sales of 15–20% like in some more modern and glamorous companies, but in general terms, we are generating free cash flow on a yearly basis, and that's what we want to obtain. We're talking about a yield of 26%, excluding the net cash of in all of them. So you don't find many companies with 15% growth in the sales and in the profits with the 7% purchase increase that we're buying. So, but we're doing okay. And this, I think we've already done a pretty good review of what we're doing in all the companies. And going back to Dixon, how do we explain the difference in the profitability with the rest of the value portfolio? It was not more than 10% at it. It was 11–12% in TK, despite the fact that the main asset is doing okay. We've had an impact of 4% with these two values. We've had an impact of 15% in our portfolio, which is the damage that we've suffered this year. There are several questions that I'm going to try to group as to the alignment of the interest in the management team and the rest of the investors, especially in years of negative profitability, where the income that we get out of our fees are the ones that we're having and the profitability is negative. So how do we align the interest of managers and investors? We've spoken about negative profitabilities in previous years, but some years are really good. We cannot say in the bad years you give back your fee and in the good years we triple your fee. This is happening in some hedge funds, but I think this is very dramatic. We've always used a fixed fee. This is the way that we've worked, and this is our alternative. At the end, we're not actively marketing the funds. Of course, the bigger we are, the better, but this is not our main incentive to grow. And the reality is that part of our savings are in Cobas. Well, 100%. In my personal case, 100% of my savings are invested in Cobas. Well, it's not true because of the contract, I have 50% in my old managing company, but luckily, next year I'm moving this, and on September 22nd, on September 21st, I will bring on that money to Cobas, and then I will have 100% of my savings in Cobas. And not only that, the incentives by bonuses that we're having in Cobas mean that 60% of the incentive is linked or invested in the Cobas fund. And this is applicable to all the management teams. So we're totally in line with the interest of the investors. What's our alignment, or what is our incentive? And in this case, I'm speaking personally. I like my job. I like to find for good opportunities. And personally speaking, I can say that I've done a good job over the years. So what I do is to invest my own savings. And we have set up a structure to invite any other who would like to participate in this project in a totally free way, in a clear way. But the basis is that our savings and our investments, so at a specific point in time, our profitability is very bad and the customers decide to leave us, we will continue on doing exactly the same thing. This is what I will do with my money. It's not that we are aligned, but this is the essence of our job, managing our savings and inviting third parties who wish to accept the way that we manage things. It's not a matter of establishing here a shop in order to make money. Things do not work that way, not here. Isn't it excessive, a concentration of more than 26% in the transportation sector? Maybe you would like to answer that question. Well, we're talking about transportation, but the two things are very different. We're talking about tankers, LNG tankers with long-term contracts, or on the spot market tankers in some other cases, and automobiles. These cases are totally specific, totally different. I don't think they can be tackled as a single sector like the transportation sector. That wouldn't be correct. I believe that we're talking about different things. If we talk about the crude oil transportation, I don't think we're reaching 26%. And if we talk about transportation, we're talking about two different concepts. On one hand, we're having the LNG tankers. These are in investment with long-term contracts. We're investing in a bond, and the return on investment is 14% in most of the cases. And then we're having the crude oil, which is a spot market, that it is more cyclical, and it is the typical stock market investment that we've always seen. We always need to purchase in the low or in the downturn of the cycle and selling in the upturns of the cycle. What impact do you foresee in the Iberian and international portfolio if we extend this stage of low interest rates at the European Union? Well, we have some Spanish corporations, but we have many global corporations, like, for example, with the automobiles, 14 million cars are being sold in Europe, but 100 are being sold in world. So we have to stop being European-centric. Next week, India exceeded Germany in the sales of the car, and they will be surpassing Japan, increasing the car sales. But luckily, we're having Hyundai, we're having other manufacturers, and we're going to be benefiting from that. Sadly, what happens in Europe is less important every day. With these levels of growth, things are not so relevant, and we're going to invest only in global corporations. And this is what's happening with all the companies within our portfolio that are more and more global every day, because the growth is in globality, not so much in a specific area. Técnicas Reunidas not paying out the January dividend is a signal of, it's a warning, or that shows that it is they are in danger? No, we don't consider that they are in danger. They have historically announced the payout dividend in January. They haven't announced it yet, but they still have a certain amount of time to do so. And I don't think they're going to cancel the payout of the dividend, but even if it happens, I'm sure that there will be a good reason to do it, because the management team and the family behind the management team make sure that they make the right decisions. Maybe they can cancel the payout of the dividend on a temporary basis during a short period of time. Maybe there will be for the repurchase of shares and to do something that it is reasonable and sensitive. So we don't think that this shows any kind of danger. And if we increase our stakes, yeah, every time the share drops, we increase our stake. And when it goes up and it exceeded some levels, we try to achieve a good balance, because we don't want it to be overweight in our Iberian portfolio. How about Telefónica's profitability? The profitability of Telefónica in the last 20 years has been negative, including the dividends. In the meantime, the main manager became a multi-billionaire, although the management was awful that he made. And this is just a question. Although the new CEO seems to be better, do you think that it is not worth investing? They are not a company within our portfolio, so I don't think we want to say something about it unless Carmen was to say something. Well, as Paco is saying, it's not part of our portfolio anymore, because the last part of the year, Telefónica was a very defensive value. Other companies dropped it more, and we thought that there were better investment opportunities in other companies, and that's why it is not part of our portfolio. We thought that other companies were a better investment opportunity. There are many questions as to the expectations of recovering the 30% losses. Well, I think we've already answered that question. Almost half of our presentation is being used to talk about the possible recovery of our losses. Past profitabilities doesn't mean that we are going to share a future profitability. The fact that we've recovered in the past doesn't mean that we will recover this time, but this is exactly what we're hoping to recover. Going back to the previous topic, there are several questions as to the possible fee reduction, because this was not mentioned in the last year conference, and some of the investors ask about this. Do you foresee any changes in the fees of the funds? We mentioned this last year, but only talking about what was going to be happening in the midterm and in different circumstances. This must not be done as a consequence of a good year or a bad year, but it should be done after achieving a certain stability within the company. But we'll think about it in the midterm, as soon as we achieve a certain level of stability. What can we expect of Cobas International? What will be the profitability in between 7 and 9, 11 and 13, 13, 15, or even greater? I don't know. If someone knows, I don't know. I can't say. I have no idea. I'm sure that we are going to have a profitability that it is going to be benefit when we are six-folding or seven-folding our profit, and we're seeing an increase on the market in real terms of 6% in the last 30 years. So it is true that we've undergone certain cycles, bad cycles in the 80s and in the 90s. That was the 20-year period with the greatest revaluation of the markets ever since markets exist. We do not know what was happened in the old times with the Phoenicians, but in the last 20 years have been the worst, surprisingly. Well, surprisingly, taking into consideration that we've had two falls of 50% in 2000, 2008, and then we've had 3 years that were very bad or not so good. But still, the profitability is not, we're not starting to invest in a bad moment. We've had some bad years in the European markets and on the emerging markets, but the reality is that if the historical average is 6%, we normally are above that historical average, and in the coming 20 years, it seems that they are going to be better than the previous 20 years. So we have an investor that mentions an interview in which you say that by 2018, after a bad year that we've lived, 2 years later, we achieve recovery levels of close to 70%. How long will it take Cobas International to recover that they lost if we continue on in this trend, with this trend? Well, we do not know exactly. We don't have the crystal ball. Sometimes you make mistakes. Sometimes you make the appropriate decisions. We will try to recover, but we do not know how long will it take us. We've seen that the last 4 times we fell, we saw significant recoveries 2 years later, and this is what has happened. Now we have a similar portfolio in terms of quality and price, and even in some cases the quality is even better. So the normal thing we'll see situations that are similar. Hopefully next year we'll come with a very strong green graph showing a wonderful recovery, but this is what we are expecting. We do not know. Your profitability has been dropping over time. Until 2009, we were reaching rates of up to 16%, but in these last 2 years, we've had a 12% profitability. Is this as a consequence of the greater volumes that we're managing now? Without investing in low capitalization companies, we cannot achieve values greater than 15% profitability. What has been your profitability in the last year, and how do you compare it with the peer reference? I don't know if you're talking about the Iberian portfolio or the international portfolio. If you're talking about the Iberian portfolio, you're fully right, because in the 90s, the Iberian market had a tremendous profitability. We went from 250 in 1996 to 750, 800 in 2008, threefolded, and obviously in the last year this hasn't happened again. Let me tell you, or let me remind you that Telefónica is now at the same price that it had in the past. But it's not a matter of size, it's a matter of market. The market was extremely helpful in the 1990s, much more than in the 2000s. But when talking about the global portfolio, this assumption is incorrect. This question was asked 2 years ago, I believe, and the calculation, as far as I remember, was that in the first 6 years, when I was working on my own, we were talking about a 10% profitability, better than the market, until 2003. Then the next 5 years, we grew 6% better than the market. And in the last ones, we did it at 13 or 40% better than the market. So it was plus 10, then plus 6, then plus 13, 14. And it was logical that it was only plus 6, because we're talking about from 2003, 2008, where we were reaching the final part of the cycle, and it was more complicated to beat the market at that time, as it has happened in the last 2 years. But 2009, 11, 12, 13, in 2000, and now we see in the results of the markets by 48%, we were doing much, much better, and 14% better than the market as an average in these last 5 years. So the assumption, the starting assumption is not correct. There's not been a downfall, but there have been ups and downs and fluctuations. And as to my personal situation, if we have to get the last year's investment for this 14 minus 15 last year. So plus 14, plus 14, plus 14, 0 minus 15 will give us a plus 10 approximately. What is the worth of having this reevaluation potential if we always sell before reaching the peak? But that's the good thing, because that shows that there are even better opportunities. Why have we sold Real Chemical from 2,600 and it is worth more? It is worth 3,000 because we have other companies that have a 100% potential. So it doesn't make sense to maintain this chemical company with only a 20% potential. It makes no sense whatsoever. This is a mathematical question. If we reach the target value, it means that we cannot find other opportunities, and that's a total disaster. This is what happened in 1998 in the Spanish stock market when we had a 20% liquidity because we have 20% invested in subsidiaries of Endesa. Total disaster. All of the companies have reached their target value, and this is the worst thing that can happen because this means that we can find no alternatives. Going back to the issue of Aritza, if we made a mistake, why don't we sell that value? We made a mistake in the evaluation of the company with 3 billion capitalization plus 2 billion debt, but nowadays with 1.5 debt plus 1,000 capitalization, we believe that it is clearly a good investment opportunity. So it is not a mistake under the current prices, the error we made it 2 years ago, not now. We're not making it again. Now it's a good opportunity, a good investment opportunity, not to mention the degree of knowledge that we've acquired about the company in these last 2 years. One investor is asking, don't you believe that the global portfolio needs a better quality approach and not only purchasing companies with low prices, at low prices? We're going to try to buy companies. The PER of the portfolio is close to 30%. This is what we've had. We decided to invest in quality in 2009, and this is the average PER that we're having, and this is the value that we've had all the time. But what happens now is that we are too focused in the tanker sector. We have a very important position there because that's the opportunity that we've seen in this last 2 years, but we're having 25% in the tankers. The rest of the portfolio is giving us the PERs greater than 30%, and if we see business by business, they're irreplicable. Babcock, it's not replicable, not to mention Dixons. Amazon wish they will have the implementation that they're having in UK, Sweden, Greece, Finland, etc. They wish they had that level of implementation, and these are irreplicable business. The Asian ones, they have in very strange names, but their returns, the capital returns are 40-50%. So you have to take a look not only at the tankers, but at the rest of the companies.
They're also asking us what differentiates us from other value managers and whether there's a possibility for us to merge with some other asset management company, of value asset management company. I don't know what differentiates us. We've been working for some with some for a very long time. We have a tail of stocks to go in to our portfolios. With the quality of these assets, it's not easy to come into our portfolios. I don't know whether there's other portfolios with 7 times profit that can show for this. I imagine they will also have good portfolios. I don't mean to say that there's not other people that do it really well. We've been competing with all sorts of people in Europe and the US for 30 years, and obviously there will be other interesting portfolios. But I think I like our portfolio the most, and our team will support me in that, I guess. And what about the possibilities of merger? No. We would dilute. We would have to go to PER 8 with a portfolio that we merged with. Can you explain the concept of volatility from Cobas' standpoint? Volatility is moving markets. There's two types of volatility. Bad volatility, which is the one in Eritrea, when we got the top line wrong, when we get the value of the company wrong, or with the cheer that I explained earlier on. That's bad volatility. And good volatility is the rest of volatility. When you get the company value wrong, the more volatility, better. The more turmoil, the better. The more volatile markets are, the better. The more things we will be able to do. The best profitability we got ever it was in 2009, and that came after the biggest plummet. So at the end of the day, you stay in the best position, but we ended up in the best position of all. So the more volatility, the better. They're asking us what percentage of your equity is in Cobas, and you already said it. And it's good to have such a good diversification in one management. I wouldn't like to have to diversify because I would have to choose worse managers than Parames. So am I crazy if I put more than 8% of my equity in Cobas? How many equities would be enough? We will have two fools. I would do it too. We know the portfolio too well, and we like our portfolio. We keep it under control, and we're delighted to work with it. But one can perfectly understand that people don't invest 80% or 90%. And that's our track record. First, it was 20, 30, 40. Some people end up with 90 or 100 invested in the management company. Any weight is legitimate. Fear is free, the will to diversify is free, and we just need to explain what we do. And of course, all of our savings are in Cobas, and we trust what we do. But you need to decide for yourselves, and that's a very personal decision. What would you say to your mother, who's not too knowledgeable about investing, when her son has made contributions to those funds, but now it's in red at minus 18%? What can I tell my mom? What can I do so that people in banks don't consider her crazy every time she wants to make a contribution to a fund such as Cobas? I'm actually going to share a story with you. Last year, Santa Claus brought 100 euros to each one of them, and this year they brought them 100 euros once again, and they said, okay, let's invest this in Cobas, and he said, no, not in Cobas. They're down by 30%, and they'll go down to zero possibly. But you need to insist, actually. And he could show some of these graphs to his mother to see if that's a little convincing. They're asking whether there is no good companies without debt, with good family control and with management history. Wouldn't you have to look in the small cap sector? Aren't you too comfortable? Well, I don't think comfortable would be the word. But if you're managing 2 billion, investing in small caps, I don't know. Juan, you attended a conference last week, and it was mostly small companies. There is a limit, of course. If we want to manage 2 billion, we need to aim for larger companies. At any rate, we have companies in our portfolio with 200 million in capitalization, so they're reasonably small. If we're interested, we can go for them. At the end of the day, we have a company stock portfolio that's a reasonable size and 6 times, 7 times profit. You can find a small cap at, I don't know, 5 times, but it doesn't really add that much to your liquidity. Between 7 times and 6 times profit, if the one with 7 times has more liquidity, perhaps that's more practical, right? Samsung's at 4. Why would you look for a small one when you can buy Samsung at 4? Look at the figures presented about Samsung. We are talking about a company with 750 billion in market cap per one, PR1. Talking now about specific companies, could you elaborate on the Dynagas thesis? We could consider that a mistake, and Andres is going to explain it. It's not that it was his mistake. I said not to do it. Dynagas is similar to TK, but there are differences. Basically, it's a long-term contract for LNG. So to that extent, they're the same. But Dynagas has no growth project. And conversely, the fleet is older. They are leaving aside former contracts and entering new contracts with a worse profitability. So the market is limiting dividends, but not to growth such as TK, but rather to pay it. And that's the situation of Dynagas. And when we interpreted it in the beginning, considering the present value of contracts minus that, the value was quite high. But the market is following the momentum of the dividend movement, and the value pays off when the dividend pays off. But that's not what the market believes. The story is not as interesting as for TK because there are no levers that they can control to determine their valuation, actually. Going back to Aritza again, they're asking us whether we haven't considered taking control over the company. Some people are asking whether we will continue to be activists. Well, taking control is something that we cannot do, considering the legislation, and it's not a role to take control over it. As shareholders, we do have a responsibility, and we will act accordingly, of course. I cannot say much more than that. But this applies to all companies, right? Not to Aritza specifically. Yes, but that applies to all companies. But when what happened to Aritza happens to us, we need to devote special effort for things to be done right. A couple of questions about UK companies. On the one hand, why do you prefer Babcock over Serco? And about Dixons, don't you think that could be an investment mistake? It's surprising that you don't go to Imperial Brands, for instance, a company that you already had in your portfolio and that you know quite well. Well, we didn't want to talk about companies that are not in our portfolio, but Babcock is more interesting than Serco. Juan, do you want to talk about it? Actually, we like both companies, but the main difference is that Babcock has a much higher quality than Sepco, in our opinion. We said earlier on that Babcock has business that is irreplicable, and this is something that doesn't happen in Serco in most cases. And it's not right to compare Babcock and Serco because actually they compete over 20% of Babcock's valuations. Even if you look it up on the internet, and you can see them both as comparables. But I would like to elaborate on what we mean to say when we talk about quality, because quality is not just about having irreplicable, unique assets that are needed by the current government, but also it's about considering how reliable the safety margin is. The difference between value and price, that is to say. I have an example of this. What happened when a Babcock contract went wrong? We want to know what the impact is in that situation. So what happened was that during the first half year last year, Babcock had situations for airplane carriers, the Queen Elizabeth carriers, and that's about 300 million a year. And they had some cost overruns. Actually, they went up to 190 million, I think. This 190 million, because of their negotiation capacity of Babcock in the Babcock Alliance, that includes BAE Systems and Thales. Well, they had a negotiation capacity, so half was assumed by the government and the other half was assumed by the state. This is especially beneficial negotiation, as the management team explained when we met with them. It's something that we have double-checked, and it's also mentioned in technical reports issued by the Ministry of Defence, by the UK Ministry of Defence. But even if the overruns had been even higher, if they had had an even more difficult situation, we are always subject to half. So we earn less, but we would never lose by contract. And they have more than 125 contracts just with the government of the United Kingdom. So the safety margin doesn't just speak about the difference between value and price, but if the contract doesn't go right, valuation is reduced, but not as much as apparently would, which is something that doesn't have with Serco, which is in addition undergoing a restructuring process. And everything will pass, but it'll take its time. In the meanwhile, we'll have a 12% intrinsic yield. Would you like to elaborate on Dixon? Well, actually, there is a mistake partly because in mobile telephony has been especially hard on Dixon in the UK. This was not something that we could foresee, but it did surprise us a year and a half ago when we sold when we bought some stakes and then sold them. In August 2017, we decreased the valuation significantly because of the smartphone business, but I was assessing this morning, and because we've been buying at the drops, our purchase price is above our current valuation. So a mistake would be losing capital, but in this case, I don't think that's going to happen. And as you explained earlier on, this is a company that has a very significant entry barrier and with very good investment possibilities going forward. And you were asking about Imperial Brands earlier on, and even though we said we were not going to talk about it, I think it's quite funny that, well, we're talking about a company that we know from the past, but companies change a lot over time, and the tobacco business in the past was very stable, and it was an oligopoly, and it has been changing recently, and the entry barriers have diminished because of e-cigarettes and all those different products. It's a company that we have analyzed, but what we consider is much better, and it's actually very expensive, and it's not going to be in our portfolio because of the valuation. It's at a PR 10 or 9. We have a couple of questions about currencies. How does the dollar affect Cobas? What's the future forecast for the euro-dollar? And are we hedged from a drop in pounds? We are hedged. We have a 25% investment in fleet, in tankers, and we think that the dollar is reasonably expensive and it will depreciate. And because it's difficult to hedge, we just hedge, but we want exposure with the tankers, but not to the dollars. But about the pound, well, we think it could drop, but after the drop it's had, in 2.5 years, I think the price is reasonable enough now. It could fall an additional 10%. It would have a small impact on the fund, but it could also have a 25% increase. We bought it when it already dropped, so we are comfortable. That's the situation. Active management, passive management. The profitability of MSC World has been 1.5, and for Cobas has been -30. So this gives +25 to passive management. To recover this +25%, we would need +33. From 5 to 8 years, do we think that participants in the fund can work on this index without mistakes and lower commissions? Well, that's difficult. Actually, historically, we did it, and we did recover, and we hope that we will do it this time. We don't have a reason to think otherwise. Our portfolio is at 6 times profit, and the market is at 13 times profit. So our portfolio should perform better than the index normally, except for the circumstances that we have experienced in the past. Are you concerned that Bankia will not fulfill its strategic plan because their rates are not going to be increased? Do you think that they will merge with Sabadell? I don't know whether they will comply or not, but truth be told, they have dropped by 50%. They are at the same price that we bought in 2012, 2013 in the second IPO, so I think the risk is very small right now. I think people are assuming that rates are never going to rise. You have to buy when the environment is bad, and in general, the environment, the landscape for the banks is not good. Juan, would you like to add something about Bankia? No, I think everything's been said. The strategic plan has a lot of dependency on interest rates, because it's not normal to have a negative Euribor. So it's a very good situation. Even we could earn something reasonable or earn a lot. So it's a beautiful situation. Basically, they're not paying anything right now for the branch network. The cost of a deposit for Bank Inter is the same cost as for Bankia, and it must have a value. Otherwise, they should get rid of it. And if they have to get rid of it, we have savings by the employees and so on. Question for Paco. What differences are there compared to your last experience? So what's the difference in having your own management company? Has your management style changed? I think I explained it already in the book. It was a matter of company management, and it didn't have much to do with investment management. That was not the reason. At the end of the day, in Enagas and Acciona, they never got into my way of managing. There's many questions that target the steel market. Acerinox, Arcelor. Ivan, would you like to share your opinion on the steel market? The steel market is better off than it was in 2015, when actually 90% of manufacturers were losing in their EBITDA. But there are doubts as to whether China will continue to export. But with the custom barriers, it's very difficult to know what's going to happen. But actually, we got into Acerinox when it went from 12 to 13 euros to 8.5 euros, and that's when we bought, because it was very affordable. And we noticed that Acerinox is a cyclical company. We've known it for quite a while. We know the management team. We've known them for 20 years or so. And they have no issues with debt. And the market was discounting a very critical scenario. And as for Arcelor, the situation is quite similar right now, but it's currently not in our portfolio. In December, we decided to not tackle that. Have you considered having a product revolving around microcaps? Because with more volatility, you participate in the period when the company creates more value. Well, there is a relationship between long-term profitability and the sense that companies, small companies, have better yields. We are focused on creating value with our normal funds, the international and national level, with large corporates, and we're busy enough with that. And as long as we have interesting portfolios at good prices, like the ones that we have, it wouldn't make much sense for us to work on microcaps. The effort that you need to devote for that is very high, and the profitability is therefore not all that substantial. Talking about net accounts, we see that there's an ongoing decrease in target value from 200 to 80, which represents a lot of trust loss of trust. Well, actually, this has to do a lot with Aritza, and that's the case of Cobas International. That's the main reason for going from 200 to 80. You're really supporting natural gas in Spain. Combined cycle natural gas plants are the ones that set prices in bids, because and it's the most expensive. Isn't electricity produced with natural gas too expensive? It is, unless it is decided that we won't have nuclears or coal. Indeed, it is a problem. It is a problem for electric generation, but politically, there is a clear idea, which is to reduce nuclears across the globe, actually, but they don't want to work with nuclear power. And coal is being shut down. Actually, in Germany, they're going to completely shut down coal in 15 years, and therefore headwind is blowing for coal and nuclears, and tailwind for natural gas. And actually, there are industrial uses too. In Europe, it's a phenomenon that started a long time ago. In Spain, 20 or 30 years ago. But in China, that's happening right now, and gas consumption is increasing drastically. They want to reduce contamination and using coal or pollution, sorry, and they're reducing coal because it doesn't make sense to use it in cities. And I think there's many uses for gas that are increasing gas consumption globally, and it's going to be the main energy and for 30 or 40 years until everything is renewable energy. So that's going to be an issue for the next 34 years. And investor is asking, what can we get if we invest in Cobas that we cannot get if we invest in Versailles Hathaway? In Versailles Hathaway, they probably have 14, 15, 16 companies in terms of PER. We're at 7, so we're buying things that have the price compared to Versailles. But if you buy something at half the price, it's normal that you will get better yields than when you buy at double the price. That was not the case last year, but it's what would happen normally, and it's what has happened to me personally. Always, actually. And I really hope that logic will rule the situation and that you will obtain better yields buying at 7 than buying at 15. Perhaps they have access to smaller companies because they cannot have access to others because of size. Buffett cannot buy at PER 7 because there aren't all that many large companies at PER 7. Some automotive companies and some of the companies that we are invested in are companies that they have invested, but their size is huge. They cannot invest in medium-sized companies. About BMW, what is it that you think about stock price, and do you think that the difference of capitalization between BMW and Tesla will remain in the mid-short term? Well, the potential for BMW is quite high. We haven't displayed it on the slides because the stake is not that big, but we consider the potential is high. And about closing the gap with Tesla, we think that right now the market is very rational regarding Tesla and other automotive companies such as Ferrari or Aston Martin. And conversely, companies such as BMW are being undervalued, clearly. So logically, in the midterm, approximately, the gap will close because the value is there, and the market should end up recognizing it. And at the same time, in Tesla, if the value is not there, because it's a company that we don't have, but if the value is not there, it should decrease. So it would be normal to close the gap between BMW and Tesla. Why has Cobas deviated so much from what Francisco argues for in his book? I don't think we've deviated that much. We've done what we've always done. We got it wrong, as we have always done. And we have a portfolio which is good, with 80 or 70% family-owned companies. The story is the same. I don't think that statement is right. What potential do we consider the concentrated fund has? A bit higher than the select fund, which is the reference, because companies are the same. The concentrated fund is more concentrated, and it was punished last year. It suffered last year, and it happened also in our previous concentrated fund. It started to take fly in 2007, which was a very interesting year. and the recovery was sharper than before. So normally the recovery for the concentrated fund should be higher than for the select fund or the Selección fund. They're asking us about our opinion on Greenplan's magic formula. It's quite good. It's quite sensitive, quite sensible, investing in good companies, good business, and good price. So it is sensible, and that's also the lines that we follow. And it's not a bad thing to follow ideas similar to those. If you only had 10 million euros and you had to choose one single geographical area of the world to invest in the next 20 years, one region, one geographical region, what region would you pick? I can't answer that question. I would buy a global index. We mustn't forget that global economies in the last 40 years have increased at 3.5 interannual year on year, and global growth would be in 3 years 3%, 4% year after year. So I think it's more sensible, to invest in a global fund. I wouldn't invest on one country index and forget about it for 20 years. They're asking us our opinion on uranium. It's another raw material. You depend on a broad range of situation. The uranium is specifically dark market. There's not a lot of information for obvious reasons, and it's difficult to forecast and estimate what's going to happen with that raw material, as is the case in the rest of other raw materials. Apparently, they're opening new plants, but in the mid-long term, nuclear power doesn't really have a good name for it, and it'll continue to suffer. So I don't think uranium is that interesting. Why, if in the past the investment mistakes came mainly from investing in indebted company, why do we continue to select indebted companies? Jared didn't have any debt. Mistakes are of many colors, and in general, if we analyze the 45 mistakes that we've made, there were many retailers that didn't have any debt, or the debt was minor, but at a point in time, business dropped, and something that is not important or that is a reasonable small debt becomes a very big problem. Some retailers have gone bankrupt because they didn't have any debt, but providers or vendors ceased to give them their trust, and sometimes companies that we invest in have no debt whatsoever. And it is an exception when there is that. Actually, the statement is not right. We invest when there's debt in Aritza and in maritime companies. For the rest of the companies, there's no debt. And it's like buying a building in Castellana. You buy with debt, with a reasonable debt, as you would with any other boat company that we are invested in. They're asking us about Iliad position. We have a stake in Iliad, in the large corporate fund. Iliad, do you want to talk about Iliad, Carmen? Iliad is the alternative telecom carrier in France. It's present in broadband and mobile. And in 2012, they released their mobile operator, and they have an 80% market share. And what happened was that in 2018, for the first time ever, they lost customers. Errors in their story, and in the French market, they are the most competitive. But if you analyze figures in depth, you would realize that they're losing customers of worse quality because they went from a customer acquisition phase to a customer retention phase. And I think this company will improve its margins sharply in the next few years because after 2020 they will stop paying recurrent cost to Orange for using their mobile network, and actually they're adding on fiber and ADSL customers, and they're going to cease to pay the lease for the ADSL network. So we consider that the company's situation will improve in the future. Therefore, it has a high potential, and it also is a company with an owner with skin in the game, because the founder and chairman has 50% of the company, and he's considered one of the best telecom managers worldwide. And we are not considering the potential consolidation in the French market too, because word has it that there might be a consolidation, and that would even improve the potential further. But we are not taking that into account. It's an extra option.
What makes objective value to change so that it will go from 137 to 175? The target value of the objective value in Iberian has changed. This target value has changed because many of the values have dropped importantly, and we've increased our position or our stake in those values. And it is also true that time goes by and the companies are more valuable every year. Eleanor was not an investment, and it was costing an X amount, and its value has tenfolded because they are adding profits, and this has to be added to the value of the company. And those are the factors that we take into consideration to carry out changes in our portfolio, considering the growth of the company, and we move from investments from one company to another. Your opinion about Vocento, the PER, and the potential for growth? The potential for growth for Vocento is quite high. Obviously, otherwise, we'll have a stake of 5%. Vocento is a press company, apparently, but they have assets that have nothing to do with the media and that are very powerful, and they are being highly valued by the market. They are right now in a very interesting transition period. Hopefully, it will be very fruitful, but we're interested about other things and that are not the most important assets and that do not support their valuation. I don't know if there's anything else that we can say about this. Isn't it too risky to lose entirely the technological sector? Well, I've been investing in the technological sector for 20 years. And as we've seen, you can obtain very good profitabilities without being fully invested in the technological sector. Well, you have to take into consideration that we like novelties, we like new things, beautiful things, but the reality is that things do not change as much as you think they're changing. I don't know if I told you that I read last year an article at The Economist that said that only 2% of the Standard & Poor's companies had suffered as a consequence of the technological changes. And if we think about it, our day-to-day hasn't changed that much, even though we're having a mobile phone that looks like a computer. The things that we're doing, we still wake up in the morning, we still have breakfast, we still have to be dressed, we wear shoes, etc. So there are many things that haven't changed despite all the technology, and all that part of the economy that doesn't change are the part in which we're interested, because in the other part, it's very difficult to find out what's going to happen. And this is more a capital risk investment. And even in a case like Facebook, who knows how will it end? Does anyone know how will it end? If Facebook will survive over the next 10 years? And if you know it, let us know. Because I've got 5 kids, they're all fully connected, and none of them have a Facebook account, and they're not interested in Facebook. Their usage index is falling. So Facebook, from our perspective, is capital risk. It's true that they are the owners of Instagram, and Instagram is making a lot of money in publicity, but will that be enough? Will they get tired of Instagram so that they won't be bothered with publicity and advertisement? I don't know. Who knows? it's interesting to follow up what's going on with these technological companies, to monitor them and for possible impact on other companies in which invested, but technological changes is not interesting to us from the investment perspective. I would also like to add that throughout history, consumers have benefited more than from the technological changes that companies. And definitely they have benefited, consumers have benefited much more than the shareholders of technological companies. Francisco participates in Quom, but do you invest on their funds? No. 100% of my money is invested on our funds. How do you do the decision-making process when investing in the new corporations? Can you let us know how you work? Yeah, well, a new idea comes up, we discuss it. We had team meetings. We don't know participate in all of the investments, but let's say, for example, that we're going to be talking or discussing an automobile investment, and the four of us who are interested on the field, we investigate, we do some research, and we took all of us, and it is a common decision whether we're going to be investing, and the selling decisions are made exactly the same way. Someone has the idea, we work on that idea in a small team, and this is taken to a larger team, and then we achieve a consensuated decision. At the beginning, I had the final word, but we try to reach consensus for obvious reasons. What is it in Quabit to invest there? It's a very interesting real estate company. Maybe Ivan can let us know. I don't know if we had a slide at the end of the presentation. Well, yeah, we do have some slides for real estate that give us some support for the investment in Quabit. I don't know if we can display them on the screen. Well, to summarize, the this is what we're seeing on the media. But before explaining why we've invested in Quabit, we have to explain why we are investing on real estate. And in order to answer this question, I wanted to use these graphs. Here you can see very clearly what is going on and what the media is reflecting. We're seeing an increase on the prices. They are growing by 8–10% depending on the area that we're talking about. For example, this is the data published by Idealista on a quarterly basis, and we can see how in Madrid, capital city, we're practically reaching the peak of the cycle in terms of price. And if we take a look at Barrio de Salamanca, this neighborhood, they're exceeding the prices that they had at the peak of the cycle. That's because their space is very limited there. So we see differences depending on the neighborhood. So when talking about real estate, we have to make neighborhood differentiations. And if we can go to the next slide, here we see the regions in which we've invested. In Guadalajara, we've invested through Quabit, and in Seville, we've invested through Inmobiliaria del Sur. And here we can see very clearly the current prices in Guadalajara versus the average of the last 10–11 years. And we see clearly that the situation is totally different to what we find in Madrid, capital city, or in the Barrio de Salamanca. And something similar happens in Seville. And this is for you to have like a general idea. And in these two companies, we have an important shareholder that has its money at stake the same way we do. In Quabit, we're having Felix Habana, who is the CEO or the chairman that holds 18% stake. In the other company, they're having the Pomar family with more than 50%. And in Coavit, we have to say that in order to analyze it, we have to dig in it, and the valuation made by independent experts that give it a value of 480 million euro, except for the debt, that it is around 214. So you're getting a 0.8 valuation, when right now the shares are costing 1.40. And to that, we need to add some haircuts achieved with some banks and some fiscal assets that they do have for the accumulated losses of the last 15-20 years. And that will give you a valuation above 2 euros, 2.5 euros approximately, and that's the reason why we've invested in Coavit. And another interesting thing as to these two real estate companies is that they have been able to survive the worst real estate crisis in the history of Spain. Buffett has advised his wife to invest 90% of the money on the stock market and 10% in governmental bonds. What will be your advice in a similar situation? If they do not know any manager that it is trustworthy, I think that could be a good recommendation. I will get a Morgan Stanley Global Index. I think that will be a very sensible recommendation. But if they're ready to work a little bit and to investigate, and if they have asset managers that are trustworthy, maybe it will make more sense. But if not, it will be cheaper to invest in this type of indexes. What are the three companies that made up your funds with the best competitive advantages? Can you explain such competitive advantages? I don't know. Anyone could answer that, whether Vicente or myself. You haven't spoken, but if you want to express your opinion about three companies with competitive advantages. Is there anything that you would like to say about this? Would you like to do a ranking? I think we've already reviewed some of them that we have in our portfolio that are very interesting, like the case of Babcock that was mentioned by Juan with unreplicated assets. This is one of the best companies that we're having within our portfolio. How about you? What is, in your opinion, the company with the greatest competitive advantage?
I think if you look at Dixons and some of the other UK names, the service side is very important. I think that's often overlooked, and that is a real competitive advantage, the scale and the service. So, and there's elements there in a number of our stocks, Dixons and others.
For those of you who couldn't understand, it's talking about Dixon and the great advantages that it has. During the drops of December 2018, the team that was managing the funds increased or reduced its participation in it. I think that in the last quarter, several people within the management team have increased their stake in the fund, and none of them have reduced it, and the rest of us are waiting to have some more liquidity to be able to invest more money. There is a question about whether we want to invest in Africa. We've already invested in Africa. We have two companies very interesting, one in the global fund, Bolloré, which is leader in logistic investments in Africa with several harbors and ports, and we are supporting Africa's development at a very interesting price. And the other one is the biggest building company in Africa. It's a Portuguese company that is started in Mozambique and in Angola, and right now they are located in many different places. Next week we're going to travel to Portugal to visit them, because we've never paid a visit to them at their headquarters, and I visited them last year. But next week we're traveling, and we have an indirect exposure to them. It's complicated for us to invest in African companies, but with these companies, we're going to little by little participate. And I'm totally sure that little by little there will be new companies taking advantages of the growth of Africa that are growing at a rate of 5% per year. And in certain countries like Morocco, well, you notice that they are changing, that they are growing, and they're little by little developing, and that is a growth that it is going to be noticeable in all the economies. It hurts these minus 20 in these 2 years, and we're all expecting this plus 20 over the coming 5 years, but it is difficult to wait. What would you tell us? I mean, well, we've spoken about a recovery in probably 2 years' time. We do not know the time. We do not know how long will it take us to recover. It is impossible for us to know, but long term can be maybe 9-10 years. If you invested in 2000 at some point in 2001 or 2, it was losing money in 2009. It is true that afterwards they recovered 150%, but it could happen that after 5-7 years we're in a negative situation because the markets are collapsing or whatever. It's very strange, but it could happen. You have to be prepared for everything. We have to be prepared for olive trees, and the good or the bad things of these downturns is that those who are not ready end up in a bad situation, but it is a hard time, and you have to go through it, and will hopefully recover. What justifies the difference in the fees between Cobas large corporations and Cobas International? Cobas large corporations is a small fund at this very moment, and we are having in Cobas not such a large companies, and this could be beneficial. The most important losses we've suffered then in the smaller companies in Aritza and TGP, and they're in large corporations and international, but the normal thing is that after a certain amount of time, international and select will provide better profitabilities than large corporations do, and therefore they will be worth a higher fee that you're paying for it. At the moment of building the companies, in building the portfolio, wouldn't have been better to maintain greater level of liquidity in the portfolios if we would have invested only in ICL or in Exor, in the companies that were okay? Well, the problem was Aritza and our mistake in there, and another companies that hadn't reached maturity yet. But it is not a problem of being more or less invested. Every time we find a good investment opportunities, and with companies with these PER 7 or 9, we're going to do it. We're never going to do market timing, trying to predict when the market is going to collapse when we have good assets at a good price. If one of the Cobas objectives is to give some tranquility to their participants and investors, do you think that you're achieving your objective? This is not for us to say it. It is for the customers to tell us whether they feel calm and at ease working with us. The reality is that we feel that they are at ease. We've had in December many reimbursements because of fiscal reasons. The rest had been net inflows. In January, we're having 400 new customers and a net inflow that was interesting. So I understand that the customers are very much at ease given the circumstances, which are not easy. We keep on hearing about the possible bursting of the bond bubble. Is the bond market overvalued? If it happened, how will this going to affect the Spanish market? Yeah, they're definitely overvalued. I'm totally sure that they are overvalued. Interest rates are very low, the prices are very high, so the situation is complicated. But the reality is that in the United States, we've moved from a situation in which we were at an interest rate of 0 to 1 to interest rates to 2, and the economy hasn't suffered. It is true that the real estate sector is not doing really good, but they're not in the middle of a bubble either, and the economy is not suffered, and they're in a full employment situation. So maybe here in Spain, we see a progressive increase of interest interest rates and with a healthy economy, nothing will happen. It is also true that the U.S. economy is more dynamic and it is less intervened than the European one. But these bonds are very expensive. I will not advise anyone to invest in bonds, but the reality is that maybe this overvaluation of them will have no impact on the economies. And maybe it won't impact the real estate sector. Of course, some people can be under difficulties if you're having a mortgage that you have to pay back at 4%. It's not the same as paying it at 6 or 8%. But it is true that the banks are being more demanding every day in order to grant these mortgages. Spain, it's reducing their mortgage indebtedness. The problem that the banks are having is that they cannot generate more mortgages in order to increase their mortgage portfolios. But I don't think we're going to have any problem in that sense. Will you advise to invest all of your savings or keep some cash for certain opportunities at this moment? I've always invested 100% of my savings at all times, except when I was going to make the down payment for my home in 2016. But it was the down payment for the house. I mean, that was very relevant at that time. And we needed to have that cash in order to get the house. Okay, in order to finish, to manage investment, what do you recommend to study? Or what readings do you recommend? I will recommend them to join Value School. There are many books there. Some of them are being right now translated into Spanish because they're not available in Spanish. But on a weekly basis, they recommend new books and they will give you recommendations as to what to study. This is an independent area with no it's a non-profitable organization, so it's a wonderful place to be trained at Value School. I think there are many pending questions, but we've already come to 8 o'clock, and I don't know if you want to finish by now or if you want to keep on going with the questions. We'll accept 2 more questions or so, and then we'll finish. We know that you've invested your money in Cobas, but will that be your recommendation to your relatives? I can't wait to get my money released from another asset management company so that I can start investing it in Cobas. So what can I say about that? And one final question, what are we doing that our competitors are not doing? Well, we work very well, very happily. We have a good team, a wonderful team, and we're having these values at PER7. We had a downturn last year, and this was mainly my own responsibility. And I don't know if I highlighted this enough in this conference today, but it was mainly my fault. But hopefully, over time, we'll recover that and we'll obtain great profits. Well, thank you, everyone. Hopefully we'll come with better news next year.